Scott Smiley. I'm here as a co-founder of HiYield, aggregating all the top tokenized asset offerings into one platform. And we're here with James from LandX. James, you want to do a brief introduction as well?
Yeah, thank you very much. My name is James. I'm a Solidity smart contract developer, and I work on the kind of technical documentation and some of the smart contracts for LandX. LandX is a way of bringing agricultural commodities on chain. We do that via a crop share mechanism. It's a thing in traditional finance where farmers can raise capital by committing to share a small percentage of the production of their land. And that's their way to raise capital. We're basically trying to bring that on chain. So for kind of farmers, it allows them to raise capital, efficient DeFi markets. DeFi investors, it provides exposure to agricultural land.
Nice. Yeah, I definitely wanted to learn more about that component specifically, like what problem you guys are addressing in the agricultural vertical. Do traditional banks not touch this stuff? What's kind of the funding gap that you guys are filling, and why would you say it exists in the first place?
I think it does exist in traditional finance. We haven't seen it in DeFi yet. Obviously, it's still very early. We transitioned to digital asset, kind of decentralized finance ecosystem. It's not when you think of farmers, you don't necessarily kind of think of technically savvy kind of people. That's no offense to anyone that's actually had an agricultural background. It's not the same as someone that's kind of working in maybe software development or the libertarian kind of cyberpunks, which kind of were around at the very start of Bitcoin and Ethereum. So I think as the industry evolves, we're going to kind of see more of a migration of real world businesses move across to DeFi ecosystems. And that's where we're trying to build a real product, something that's kind of been proven in traditional finance markets, kind of bridge that to decentralized finance.
Quick side question. Do you know what the actual financial product is called in traditional finance when you're financing future crops, essentially?
Yeah, I think it's called a Leon contract.
Got it. So if this is a traditional finance product, kind of how do you see you guys stepping in and competing or like offering a better service? Like kind of what efficiencies do you bring, or how do you see this being a superior product to these traditional loans?
I think that there's a lot of inefficiencies with the farmers in certain parts of the world are exploited with the terms of their loan. And there's got both in kind of terms of high rates and kind of inflexibility within the contracts themselves. There's no kind of openness or transparency. And it's really designed by the banks or the kind of the finance people that are creating the loans to protect themselves rather than to kind of create a product that's both good for both the investor and the farmer. Where LandX can come in is they can kind of bridge that gap between the kind of sophisticated investors in traditional finance and the farmers that are kind of trying to raise capital. At the moment, we need some kind of centralization there to bridge that. With all kind of real world assets, there's no way to do it in a fully decentralized manner. If something's a real world asset, then you need some kind of legal entity to own that or to manage it or custody it. We're going to be doing that through LandX itself. We're going to be the sole validator. But the plan is over time, we'll actually kind of decentralize. So we'll have third-party localized validators for each region. So maybe Vietnam will have a region, Brazil will have be a set region, and that will kind of have a tree-like structure where all the validators, they might have sub-validators and they manage the individual farms for a particular kind of sub-region or county within that country. So we have this structure where we can decentralize as much as possible, and all the kind of stakeholders in the program, and their incentives are aligned with the main project and the token holders.
Got it. Yeah, I understand what you guys are doing in terms of bringing these types of financial products to the DeFi native, to the crypto native investor that, holds some of their wealth in USDC. Still a little confused on what this benefits the farmers, like working with you guys over a traditional financial institution that would finance this. Are you offering kind of better rates, like a better borrower experience? Are you able to approve the loans faster, like things of that nature? I'm just kind of curious on that.
I think the actual process is going to be very similar. We still have to do our due diligence. There's still going to be some red tape to go through, some hoops to jump through, but the capital, we do checks on the farmland, the ownership of that farmland, and there's some processes which involve satellite imagery to kind of prove that the farmland is actually productive as well, and how much we kind of have to verify the production of that farmland. That side of it still is going to be there. We can't make that go away. Where we can add efficiencies is by offering better terms. I don't have the exact figures, but my understanding is that the terms that we can offer, because we kind of connect the investor directly to the farmer, as opposed to being wrapped up in a financial product and by a corporation, is better. and also the term. So whereas you probably have a fixed contract, which might be like a 49-year lease or something for a standard crop share agreement, what we have is a system where the farmer can actually kind of pay off the loan at any time. You can do that just by kind of buying back the tokens that you sold, and an NFT, and that will close his obligation. So it adds much more flexibility for the farmer as well. They're not kind of locked into anything specifically. They know the terms. I think everything on the blockchain is transparent, open, which adds some security as well for them.
Got it. So it's really comes down to better terms, more flexible loan structure. I think it was interesting you were talking about earlier how, there's only so many things that you can abstract away or improve on using blockchain, because I think there's a lot of misconceptions out there that some of these issues are technology issues, when in reality, a lot of the issues about getting access to these types of deals or offering this type of financing also comes down to legal, regulatory, and due diligence requirements, right? Like somebody needs to hold custody off chain. Someone needs to check in on the farmer that they're actually indeed farming and growing crops, doing all that type of due diligence in the real world. So there's always going to be that gap, but blockchain can come in with more flexible terms and more efficient payment rails, I think, is really where we see some of the efficiencies. And on that note, I'm kind of curious to hear a little bit more about flow of money, if you can share that. So like, let's start with somebody who has USDC, and then maybe if you can walk me through how it gets into the hands of a farmer and they use that, convert it to cash to, pay their expenses.
Yeah, absolutely. So the flow of money would be from the investor. They can buy like an X token. So we have four different crops. We have corn, wheat, rice, and they can buy an X token, which is like a perpetualized vault. So one X soy token will kind of give them a perpetual vault of 1 kilogram of soy per year.
And is that backed by multiple different farmers? Sorry to jump in.
That's a fungible token. So that's kind of diversified across the entire platform. One X soy is just the same as any other X soy. So it doesn't matter where the soy is grown, that token itself is fungible with any other one.
Right. But in terms of like where the ultimate credit risk is for that X soy, right? Like someone's got to actually sell and deliver the proceeds of their soy in the real world. Yep. Is that attached to one farmer X soy, or do you guys grow like a network of soy farmers that all kind of back the X soy token production?
For us, there's value in implementation. Obviously, that's something that we can build up on over time. At the moment, there already is multiple farmers for every product. And part of the crop share agreement is that the legal contract side of it is backed by the land. So if for any reason they decided they weren't going to pay or they couldn't meet the obligation, then what actually happens is they don't sell the land, they offer the land to another farmer locally who can actually continue that contribution. I'm not an expert on the legal side of it, to be honest, but that's my...
I won't keep poking you then. So let's continue on the kind of flow of USDC there. So the first step is a crypto native user has USDC. They put it into this soy vault and they start earning X soy. Is that correct?
Yeah. So yeah, the X soy is the perpetual commodity vault. It's an ERC20 token you can hold in your wallet. You have to stake it on the platform to actually earn the commodity. So
X soy is the representation of your holdings in the vault, and then you stake that and you earn the actual soy proceeds backed token, I guess.
Yeah. So there's a bit of an obfuscation here where you actually earn a commodity token, which is called a C token. One C soy is valued at the exact equivalent of 1 kilogram of soybeans at the kind of Chicago commodities future price. The X tokens trade on Uniswap. They're at kind of fair market value. And then the C tokens, we actually have an internal marketplace, which uses an Oracle feed from Chainlink to get the price data from Chicago Futures Exchange. And then each day that's updated, and anyone that kind of has earned a yield in C tokens can exchange that for USDC in the vault. Also in that vault, that once that fills up, that gives us the capacity to onboard more farmers, which then the flow of money then is then available to farmers to take out. And they have to also contribute. So when they take out a loan, they have to...
So the farmers have access to the X soy vault, right? So when USDC, just going back into the flow of money, USDC starts with a crypto native, it goes into the X soy vault, which then they can stake and earn C soy. But going back to USDC, that USDC is in the vault. And then I imagine you guys, the LandX team, can withdraw that and send it to farmers, or kind of how does that flow look like?
So the USDC doesn't directly go into the vault. So someone trades on like USDC for an X token on Uniswap, it goes on to the other side of the Uniswap pool. From there, we onboard farmers so that we can kind of keep that pool stable. So what we want to do is kind of achieve, so obviously the commodities prices are fixed to the commodities futures prices, and we want to create a we don't want to onboard farmers too fast. We don't want to onboard them too slow. We want to create a kind of steady price appreciation relative to the net asset value of the product. And to do that, we would then manage the vaults so that the capital goes into what's called a rent foundation contract. And that's made available so there's a kind of an admin function which is controlled by the validator. They have authority to kind of give out them loans based on the due diligence of new farms that are being onboarded.
Okay, so the farmers, like, how do they end up with USDC? From my understanding of what you previously said is they actually receive one of the soy tokens and they sell it on Uniswap to get access to USDC. It's not like quite a loan from LandX. Is that correct?
Not quite, no. So what they would do is they would contact a validator and say, I want to raise some capital. I'm willing to contribute up to 10% of my farm's annual production, and that at the USDC value, and then they would have an NFT minted. This was originally LandX a year or so ago was actually designed as an NFT product to kind of create these land NFTs that people could kind of buy and sell, which created the access to farmland. We have a system now where we can optionalize that NFT down to X tokens. So there's kind of metadata in the NFT, which represents the legal contract for the crop share agreement, which says how many X tokens can be minted from that NFT. So if the farmer's got, say, with argument's value, like 10 hectares of land, and each kind of hectare produces $10 of crops, is kind of the value of that is $100 a year. And then he can maybe take out a loan based on a $10 a year crop share agreement. So he can mint $10 worth of production per year. He has a fixed amount of X tokens he can mint based on that kind of legal contract. Does that make sense?
Okay, got it. Yeah, it does. So pretty much he gets to mint tokens to himself that he can then sell on the open market. You guys are going to try and keep stable pricing on some kind of DEX to make sure that they can sell their commodity tokens, and that's how they ultimately get the funding. Is that right?
Yeah, we're very lucky to have quite a lot of liquidity. So the liquidity pools are going to be quite healthy anyway, which gives us kind of a buffer to work with when we're onboarding more farms.
Got it. And then I guess, is there a place in terms of keeping the price stable? That's something I'm curious to hear a little bit more about before we move on from all this technical stuff. You said you're using Oracle pricing from the CF Commodities and Futures Exchange. Can they be redeemed? Is there kind of a full circle arbitrage that you guys enable that market makers are going to be working, or how do you plan on keep the price stable otherwise?
We don't have any control over like the MEV side of it, and the market makers that can do the very technical arbitrage opportunities on Ethereum. I think there will be kind of more generalized kind of market making where if price gets too far out of line, it just becomes an obvious buy. Obviously, the lower the price of the X token, the higher the kind of APR yield will be. And so at a certain price, it just becomes an unattractive product. At a certain price, it becomes very attractive. And I think there's a chance as well that'll be affected not only by the price of futures, but it'll be the X tokens, particularly because they trade on fair market value, they'll be affected by general crypto market cycles and market sentiment, which kind of is a bit all over the place in crypto markets. So it's something that I think we'll probably end up employing a kind of external market maker as well to kind of manage that side of it for us.
Got it. Okay, so there is no like clear redemption mechanism. Like USDC, obviously, like maintains its peg. It's always redeemable for $1 and always mintable with $1. So there's that kind of full circle arbitrage. You guys, there is no full circle arbitrage on the commodity tokens. I just wanted to confirm that.
On the X tokens, they trade at fair market value. It's what anyone kind of values that yield at. So you've got a perpetual yield contract, and that will be, we don't really have much control over how that's traded. With the C tokens, we're actually using an external oracle. So the commodity tokens themselves, we set that price daily based on the commodity and futures exchange. So they're traded at the exact amount in US dollar terms for 1 kilogram of soy or 1 kilogram of wheat, or whatever it wants you're trading.
Got it. Okay. All right, yeah, I'll stop hammering you on technical stuff and going back to something you said earlier, like about, operating in different regions. You mentioned like Vietnam, local validator, and all these different regions. I was curious where are you guys starting? Do you have a geographic focus, and when would you expand? Kind of just curious how things are getting started.
Unfortunately, because of the kind of crops we're dealing with, we have to actually start globally, which is a blessing and a curse in some ways, because it protects us from if there's a major problem. Obviously, we do need diversification. We don't want all our eggs in one basket. But from a management point of view, we've got to kind of, even from the very start, we've got to kind of managing legal contract and the legal frameworks of multiple jurisdictions across the globe. So that's certainly been something that's taken a lot of time to get right. The project was actually started, I think, probably nearly 2 years ago now. So it's something that's been a long time kind of working out that legal framework and which jurisdictions are kind of the most beneficial to kind of operate in to start with. It's not something I have a lot of insight into. To be honest, I write code. I don't get too involved in the kind of the legal side of it, but yeah, it's a challenge and a blessing.
Fair enough. How many farmers are you guys starting with, out of curiosity? Do you know that?
I do not know, to be honest.
All good. Going back to the, I was asking you a lot of technical questions and trying to understand how things work. My main kind of objective here is trying to think about how we could structure something between HiYield and LandX. We target 9-month or less duration typically. We want like short duration, fixed term loans. And I'm trying to think about ways that we can structure maybe some kind of floating rate product that's dependent on commodity prices, and then offer that in our lending market. People can get leveraged returns against commodity price fluctuations while having some principal protection. So like that's the key thing I was trying to understand, is some way to try and structure a deal with principal protection. Do you have any thoughts on how we could, maybe that detail is a tough one to answer on the spot on a Twitter space, but any thoughts on collaboration or something that we could structure together to get land in the lending market?
Following our conversation yesterday, I spoke to our CEO. I think he was meant to be doing this call, but he ended up having to be travel. So he seems pretty interested. I've actually got some questions to grill you on now. With regards to HiYield, I had a look at the app, and like the APR for like a treasury bond is like 5%. I assume that's the lowest risk product, which is why you started with it. As you kind of move up the risk curve, what kind of APRs are you looking for, like more high risk products?
Yeah, I do think, especially with the default that we just saw in Goldfinch, like pricing a deal is going to be a key component of how that's going to work. But in terms of, if we're looking at AAA rated debt and that's yielding between 5 and 6%, we would want, a healthy credit spread above that for anything that had more credit risk. So, it does come down to the due diligence and, who the ultimate creditor is and the legal structure. Those are all things that we could discuss. But yeah, I'm looking at, kind of high single digit, low double digit, depending on credit profile in terms of the yield we would expect.
And like from the investment point of side, for the investment side, once you've applied leverage to that kind of product or a basket of those products, how would the leverage influence then those APRs for investors?
Yeah, definitely. That's what I'm kind of excited about with this product. You can take on, obviously leverage can be dangerous for the one using it, but you could increase your yield considerably even at a 50% LTV. I don't have numbers off the top of my head on exactly how much you can increase the yield, but in terms of like the percentage increase, like from 5% to 10%, for example, that'd be 100% increase. Not 5%. That's like how I'm thinking about it. So you can really increase your yield using kind of the looping trade that people talk about.
Yeah. So like what I'm thinking is you have something like a treasuries or like maybe a diversified portfolio of assets. So I noticed on your website you had Coinbase corporate bonds for like 15%. So is there like almost like an arbitrage opportunity where if there's corporate bond at 15%, you could borrow money from the credit vault at 5% and create. Is that how that leverage system works? Is the credit vault applying the fund?
I could see the confusion because you're looking at kind of our current website. Current website is just the proof of concept. Our credit vault, I can see why you think that. The credit vault is more of like a line of credit to HiYield, where we use it to originate new opportunities, and it's essentially backed by the assets held in that LLC. And then the other issuance was a treasury bond. Those are kind of just really easy things for us to issue initially, super low risk, run the proof of concept and make sure everything ran smoothly. But longer term, our next feature is going to be the lending market, where we have these isolated lending pools where, LandX would have their own lending pool that sophisticated investors, if they wanted to, could lend against just LandX assets to control their duration and credit risk, because they're like, this is LandX, this is the only collateral I'm lending against. Or they could lend to the passive pool, which has exposure to everything, could be used to loan against any asset on our platform. So the lending market's not live yet. We're currently building that, almost on testnet. It should be on testnet at the end of this month, from what we're currently looking at.
Fantastic. Okay. So you're currently deployed the current product on like Ethereum and Avalon, and you plan on kind of Or are you planning on having like cross-chain tokens, or talk a little bit about how like your plans are horizontally scale across different blockchains?
Yeah, right now our plan is to stick with Avalanche for the lower fees than Ethereum. And Avalanche has been really supportive of tokenized assets, real world assets, just the entire vertical. Had a lot of good conversations with their team. And then even publicly, they commissioned an article by the block on real world assets. And they launched this Avalanche Vista fund focused on deploying 50 million in their ecosystem to buy tokenized assets. So we're pretty excited about building in that ecosystem. We'll probably try and focus most of our efforts there. The Ethereum proof of concept is mainly there because the people in our network that were helping us test and helping us do this proof of concept all had their stablecoins on Ethereum, and just made sense to do for the proof of concept. But the next focus will be Avalanche.
Okay.
But that doesn't stop us from working with projects on other chains, just to clarify, because we can work together, structure a deal, put it into an SPV, and then just issue the token on Avalanche. It could really be issued anywhere. So from a technical standpoint, it should make a difference to you guys. And then I guess I'm sure if you have other questions, maybe squeeze in one more.
What's the first? The first question is when governance token.
Well, definitely no answer to that one. That's a strong no comment for me.
Great question. I'm curious about was it mentions on the current website that you're using zero coupon bonds. My somewhat naive understanding of that is that it works a little bit like a accumulation ETF, where nothing's kind of paid out. It just kind of trades at the open market, just somewhere around its net asset value, and that appreciates over time.
That's exactly right. You could also think of it as like a deferred interest loan. It's just nothing is paid, or deferred loan in general. All principal and interest is paid at time of maturity. That's basically how we structure all the deals, and that makes it really composable with other DeFi products, which is kind of why we went that direction, with the token just constantly accruing value, and then at some point having a redemption value, because if we were distributing interest based on who was holding it at what time, and then DeFi protocols would need to figure out how to claim their interest, would be kind of just harder to integrate into other protocols. So we wanted to make it as flexible as possible.
Are you planning on those tokens kind of trading on third-party decentralized exchanges?
The tokens themselves should be only holdable by whitelisted DAOs or people. In theory, they could trade on Uniswap, but to be able to hold the token, you would need to be on the whitelist. Otherwise, the transaction would revert. That's the current structure that we have right now for our legal guidance. In terms of trading, that's definitely the way forward, but you could think about the lending market for fixed income product is somewhat similar, where if you are holding an asset that yields 10% interest, let's say you're holding 100K of it at 10% interest, and then you borrow against it at 8% interest, let's say 80K, you've essentially sold 80K of that for a profit. If you could think about it that way, it's somewhat similar when you're doing fixed income. Lending market provides a similar economic outcome.
Okay.
But, yeah, great questions there, James. Really appreciate your time. Looking forward to working together more and talking about how we can structure that deal. And yeah, let's do this again soon.
Thanks very much for having me. I'll have our CEO contact you shortly.
Awesome. All right. Sounds good, guys. Thanks everyone for your time. Take care.